Hello friends, in the previous class I gave you the introduction of capital budgeting, theory part, and also we have discussed about the different types of capital budgeting. The first one, capital budgeting method, traditional method, payback period method. We have done some problems also. Now in the same traditional method, the second traditional payback period method is that accounting rate of return or average rate of return, ARR we call. So this ARR, we are going to work out the problems. First we'll have a theory part and what are the formulas, how we can work out the problem. Simple one, it's quite easy, don't worry. Just focus on this video and you'll get a very good understanding. This ARR, we call it as a accounting rate of return or average rate of return. Anything we can say. So what is this means? ARR measures the profitability investment. Profitability investment, we can just measure it through this ARR. So whether it is profitable or not, how much is the ARR? Suppose say we have two projects, project A and project B. Project A and project B. So we calculate ARR based on the financial information, financial statements, accounting. Financial accounting, whatever we have the information, with that we'll be calculating the ARR of project A and project B. So we can say which project is good. The project which one is giving much higher rate of ARR. So this is 2.3, this is 3.6 ARR. Which one do you recommend? B, obviously, because ARR is more. So profitability rate, when we want to calculate by using the financial accounting information, we'll be calculating this average rate of return or accounting rate of return. So how we can calculate? There is a formula for this. ARR is equal to average annual profit after tax. Average annual profit after tax. Every year we'll be getting some annual profit. That is after tax we have to take. If it is given before tax, deduct the tax. Then after that, whatever you get after tax, that inflow will take. Average annual profit by average investment. Average annual profit is quite easy to calculate. Suppose 4 years profit is given. 4 years profit will add, divided by 4, average profit will get. So average profit, that divided by average investment. How do you get average investment? For average investment, there is another formula. It's quite easy to remember. 1 by 2 into initial cost. Initial cost means investment, whatever we put the investment. 1 by 2 into initial cost minus salvage value. Salvage value means waste value, scrap value. So 1 by 2 into initial cost minus salvage value plus salvage value. Close this and add salvage value, add additional working capital. Most of the time this you will not find in the problem. Additional working capital and salvage value sometimes you will find. If this is also not there, then what is the formula? Average investment is equal to initial cost by 2, that's it. Initial cost by 2, that's it. If you find salvage value minus and then add, that's it. So like you can calculate average investment. What is the formula? ARR equal to average annual profit after tax by average investment. Average investment is, this is the formula. 1 by 2 into initial cost minus salvage value plus salvage value plus additional working capital. And what are the benefits of this ARR? The first thing is that this ARR is based on the accounting information. Accounting information means accurate information, no doubt at all. With this base information, we are going to work out accuracy we are going to get, and it's easy to understand. Anyone can understand that what is this ARR and how much is the rate, and according to that we can take the decisions, we can have an understanding. So it's easy to understand profit of economic life. It gives the profit of even the entire economic life in the sense for that project, for that business. So it gives a clarity. It gives the more information about this economic life of that project and familiar to the executives. All the executives who are into the finance field, they'll have a very good understanding. It's quite easy and interesting to find out. It does not have any problems. So this is about ARR. You'll get much understanding if you work out problems on ARR. So we'll go for the problems, practical problems of ARR. Now we'll work out a problem related to accounting rate of return or ARR. So here the problem is given the following particulars shown in below table refers to two projects. Two projects information is given to us. Particulars of X and Y. Cost 40,000, 60,000. Estimated life is 5 years both the project. Salvage value or wastage is 3,000 for both the projects. And also given to us estimated income after tax. Means inflow, cash inflow is given to us year on all the 5 years, X and Y. For X it is this much and Y is this much. This is the investment. Every year we are going to get inflow of this much. Investment is 40,000, 60,000. And we are required to calculate the ARR. ARR formula already I have written, average annual profit by average investment into 100. Average profit, how do we get? Average investment formula is already, as I told you, 1/2 into initial cost minus salvage plus additional working capital. So first we'll go for average annual profit. Average annual profit of project X will take. Average annual profit, how do you get? Add everything divided by 5. So 3,000 plus 4,000 plus 7,000 plus 6,000 plus 8,000 by 5. We'll be getting this. So we'll calculate everything. 3,000 plus 4,000 plus 7,000 plus 6,000 plus 8,000 divided by 5. So 21,600. So this is for project X. Average annual profit for project Y will take. Y is 10,000 plus 8,000 plus 2,000 plus 6,000 plus 5,000 divided by 5. So let's calculate this. 18,000, 20,000, 26,000 and 31,000. 31,000 divided by 5. 6,200. So this is annual profit. Also we'll calculate average investment of project X. X, what is the formula? 1/2 into initial cost of X is 40,000 into 40,000 minus salvage value. Salvage value is how much? 3,000. 3,000 plus salvage value. So this comes to 1/2 into 40,000 minus 3,000, 37. 37 plus 3,000. So 1/2 into 37,000 plus 3,000. 37,000 if we calculate 2 ones 18,000 plus 3,000. So it comes to 18 plus 3, 21,000. 21,000 is the average investment of X. In the same way, average investment of Y. 1/2 into initial investment is 60,000. 60,000 minus salvage value 3,000 plus 3,000. So this equal to 1/2 into 60,000 minus 3,000, 57,000. 57 plus 3,000. So 57 means to 28,500 plus 5,000. So it comes to 500, 31,000, 31,500. So we'll apply ARR for project X and Y. So ARR for project X. What is the formula? Average annual profit. Average annual profit is here. For X is 21,600. 21,600 by investment is 21,000 into 100. In the same way, ARR for Y. ARR Y is average annual profit for Y is 6,200. We got already 6,200 divided by average investment is here for Y 31,500 into 100. We'll just calculate it. 2160 divided by 21. 2160 divided by 21 comes to. So if you calculate, we got 26.67% is the X. ARR for X is 26.67. ARR for Y is 19.68. So at the end, what would you like to say is ARR? Which one is recommendable? Means obviously we'll say 26.67 is the highest ARR for project X. We would recommend project X. So let me give you a recap of ARR. Simple thing. The only thing is that you have to remember the formula. ARR is equal to average annual profit by average investment into 100. What is the information given to us? According to that, we'll take this. Average annual profit. Average annual profit means, so all this profit divided by 5. So like all the profits divided by 5 we got for project X and project Y. And average investment formula is 1/2 into initial cost minus salvage plus additional working capital. As I told you, additional capital most of the time you won't be given. So just ignore it. 1/2 into this is initial cost minus salvage value plus salvage value. That we have applied for project X. This is here 1/2 into initial cost minus salvage value plus salvage value. So we got investment, average investment for project X in the same way project Y. Applying the formula, ARR is equal to annual profit is 5,600 divided by, so average investment 21,000 in the same way for project Y also. So we got ARR percentage 26.67 and 19.68. That's simple ARR. So hope you understood this ARR problem, and shortly we are going to work out some more problems related to many transactions, many methods like NPV, IRR, PI. So please be in touch with me and refer the previous classes. It will be easy for you to understand. After referring each and every class, please take out any textbook. More problems you try to work out, so you get a more clarity. And do share these videos, practice daily, enhance your career, enlighten your life. So thank you all, take care, good luck.